Well, if you thought that 2022 would be like 2021, you're probably pretty upset right now. We didn't get the start we wanted, and now inflation keeps rising, interest rates are about to kick in, and your portfolio is probably going sideways. You're probably losing a few bucks. Now, the question that you have in mind is, am I going to enter in a market correction or even worse, a market crash in the upcoming month? The answer to that, I don't know. However, I do know what you should do right now to protect your portfolio and make sure you're well equipped for that roller coaster ride. Dividend investors, bonjour. My name is Mike Yahoo. I am the founder of Dividend Stocks Rocks, and I am a passionate investor. I have built this YouTube channel for you to invest with more conviction so you can enjoy your retirement. Give me a thumbs up, subscribe to the channel to make sure that you do not miss all the tricks and the stock picks I have to offer you on this channel. And today I'm offering you 4 things that you have to do right now in your portfolio to ensure that your portfolio is good and it can weather any kind of storm. So the first thing that is super important to do is to review your sector allocation. You know, in general, sector allocation and asset allocation will probably explain 90-95% of your total return. In 2021, if you had invested massively in the oil and gas sector, you probably had a wonderful year. In 2022, if you are heavily invested in tech stocks and growth stocks, you're probably biting your nails right now because it's not working well. So I've prepared this small chart here where I've divided sectors either for people that are looking for income and conservative investment and those that are looking a little bit more for growth. It's not perfect, and then some investors can make another kind of mix, but here the point here is if you want to protect your portfolio against market crash, you want to have a larger exposure to businesses that are stable in time, that has upcoming cash flow all the time, very easy, predictable business model, such as consumer staples, REITs, utilities, and healthcare. Those businesses will likely do well, recession or not. We need to eat. We need to have a place to stay, we need power, and we need our health. So basically, those would be your best sectors to go. If you're looking for a little bit more growth, well, then you can surf interest rate hikes with financial. Canadian banks can do very well in that environment. Information technology has been a growth sector for many decades now. Consumer cyclical, well, the name it says it by itself. So whenever the economy goes up, those will go up as well. And finally, industrial, which will also follow the economy. So those are interesting. Even if you're an income investor, you want to have like a small exposure to those. But if you want more growth, well, it's time to maybe leave a little bit of REITs and consumer staples behind and focus on growth potential sectors. I haven't told you anything about materials and energy, right? Well, it's because that since I've been investing since 2003, I've went through many economic cycles, many market crashes and recession. And one thing that I've realized after all those years focusing on dividend growth investing is business model that have their entire business model based on commodity price will not make great dividend growers, because whenever the commodity price goes up, you look like a genius, you're making a ton of money, the business is generating cash flow like there's no tomorrow, and they increase their dividend. What happened when the commodity price goes down? And it happens all the time. Well, they get short on cash flow, they cut down their dividend, and then your investment goes down the toilet. What you see here on this graph is obviously the comparison between the index of the S&P 500 versus the energy and materials. So over a short period of time, you look like a genius when you are able to catch the bottom, but over a longer period of time, you're kind of missing the boat. So for those, if you're able to catch those ups and downs, kudos to you. That's great, and it's a strategy that works. If you haven't projected the oil bust of 2014 or the one that happened during the financial crisis of 2008 and 2009, well, maybe you want to join us in dividend growth investing and focus on something a little bit more stable. The ideal sector allocation would be that your favorite sector, depending if you're income or growth investor, you get 10, 15, up to 20% per sector. So just pick the best stocks out of them, and then you can have like a little bit more protection by a better diversification, investing in 8 or 9 sectors. So with sectors maybe of growth with a little bit lower exposure, 5-10% would make it easy for you to understand. The second thing that you have to look at once you have set up your sector allocation is the dividend triangle of each of your stock. I've done many videos about the dividend triangle. I keep talking about that, but it's quite simple. Look at the trends. Trends for revenue, earnings, and dividend. Whenever there's a pause or there's a drop, there you have your invitation for investigation. It tells you exactly where to look to understand the context, to understand what's happening. And when you can find companies that are thriving, having a strong brand name, invest in innovation or R&Ds or mergers and acquisition, they have strong pricing power, healthy margin, robust balance sheet, they will grow their revenue, their earnings, and also their dividend. Why am I so focused about dividend growers? Well, it's kind of simple. Study shows that dividend growers and initiators tend to outperform the market and do it with less volatility. So it means that you have more money in your pockets, less headaches. I'm pretty down for that kind of investing, aren't you? The fact that you select companies with strong factors such as revenue growth, earning growth, and dividend growth will ultimately lead to businesses that should do well over a long period of time. And if they do well, technically your portfolio will also do good. So there you go. The third thing you must look at once you look at the dividend safety, the dividend triangle, is the dividend safety of your portfolio. So already, if you have focus on the dividend triangle, you have a pretty good idea of what it looks like. But then once you have a look at those 3 metrics, you need to dig a little bit further. You need to look at debts. You need to look at payout ratios. You need to look at how cash flow is going. And ultimately, if you can rate all your stocks from like 1 to 5 or 1 to 10, that works perfectly. What you see here is our system at Dividend Stocks Rocks, where we have a pro rating system and a dividend safety score. The point here is to help our members to have a guideline, say, hey, those stocks need your attention right now. You want to make sure that you don't hold too many companies with a very high yield and no dividend growth over the past 5 years, because those could eventually lead to dividend cutters. And you know what? You don't want to have dividend cutters in your portfolio, because look at what happens. This is Maastricht, known REITs, very popular for its generous yield in the States. And what happened? Well, you can see it back in 2017, 2018, 2019. You see the dividend growth is slowing down, and then the stocks is having some problem. And if you have looked at the dividend triangle of Maastricht back then, you would have realized that the stock was going nowhere. The business was slowly dying. It was not doing well. And what happened? Well, pandemic just pushed Maastricht off the cliff, and then you got the dividend cut, and at the same time continuously losing capital. So a dividend cut completely destroys your portfolio because you're losing income and you're losing capital. As a retiree, this is definitely not what you want. So you want to make sure that the stocks that you have in your portfolio has a very strong dividend safety. Finally, for all of your holdings, look at your investment thesis. A lot of people keep asking me, Mike, when do I know it's the right time to buy? When do I know it's the right time to sell? And my answer is always the same thing. It doesn't matter how much money you're making or losing on a stock. Go back to all the reason why you have determined this company deserves your money and deserve a place in your portfolio. So identify the growth vectors, identify the potential threat, identify the opportunities. It's really like a SWOT analysis with strength, weakness, opportunities, and threat. You then know where the company should go. As my good buddy Peter Lynch says, know what you own and why you own it. So this becomes your reason to buy, this becomes your reason to sell. So to wrap it up, first thing you do, look at your sector allocation. Then you look at the dividend triangle. After that, you have a pretty good idea of the dividend safety, but it's important to rate them to make sure you don't suffer from a dividend cut. And finally, write down your investment thesis and review them for each of your holding. Right now, it's the best timing to do some cleanup in your portfolio. You're probably still way ahead of your financial plan if you have been investing for the past 5 or 10 years. So now is the perfect time. If you have enjoyed this video, I've done a complete webinar about the 2022 investors game plan. So we're talking about strategies, we're talking about how to protect your portfolio, and that happened 2 months ago, but lucky for you, you don't have to register, you don't have to do anything. You just have to click on the link below and look the webinar replay right away. It's about an hour long, and after that, I go on to answer all kind of questions. So you're gonna have a fun time. You can get a lot of resources over there, and you will get ready for the next market crash. To end this video, I would like you to go in the comment and tell me, how do you intend to protect your portfolio? Are you selling some of your stocks and going cash? Are you going all in a specific sector? Tell me about your strategy. We're going to have a great discussion, and we're going to help each other's out in this community, because the most important thing is, obviously, you know that, stay invested. Cheers, guys.